Welcome to the daily update, where I'll go over the action in the market for Friday, October 18th, and then we'll see how things look for Monday, October 21st. Had another up day. The S&P set an all-time high, as did the Dow. The Dow was looking a little shaky right to begin with because American Express came out with their earnings. Even though it was a good report, there was a lot of selling that went on, and that was dragging the Dow down. But in spite of that, the Dow was able to eke out a new all-time high. We're still looking positive, but now we're getting a little extreme as far as sentiment is concerned. We're at that 75 level, and that's where we think maybe the market is a little too positive. We hit that 75 level after Monday, almost a week ago, and then we declined after that. Is something like that going to happen? Now, Friday was also options expiration, but we were not above average with volume, which is really strange. Usually, when options expire, we see a real spike up in volume. Didn't happen this time. It's kind of one of the off months right now. Usually, it's the end of the quarter when we see a really big spike in volume. But we're above all the moving averages. You could say that we're looking extreme positive, but at the same time, we are positive nonetheless. There's a thing called the SPXInvesting Program. It's a program that I have developed. It's free until the end of 2024. Feel free to check that out. There are additional videos that I post there and additional opportunities, excuse me, that you have available to you. You can set up a time to talk with me either on Skype or Zoom or whatever platform you use. Another benefit is that you get immediate access to the daily and weekly videos right after they are prepared. Also, the daily video, and I say this in pretty much every video, but I have folks that just watch some of the outside videos, especially the weekly video, but everything ties into the daily video. That's where we really see these subtle changes start to take place. Sometimes they're not very subtle, but in an environment like we've been in lately, just seeing these little changes here and there, we watch them to see if they turn into anything. And sometimes they do, sometimes they don't, but we like to be aware of those anyway. Okay, let's go back and talk about what happened, and then we'll look at some charts. We did have a higher open, and what we saw before Friday's session was very similar to Thursday's session, where the futures were looking strong, but then we saw a lot of selling right after the open, and that kind of took the flare out of the market. Well, it looked like maybe that was going to happen this time too. We did have a higher open, and oh, good, prices are shopping above. That's great. It should be chopping above and below the daily pivot. So there was not an awful lot of conviction right after the open, and then we climbed up to R1 at 58.67. But right when the market opened, it looked like, okay, we could easily break lower from here, but we didn't. Then prices chopped above and below R1 before closing slightly above R1. So not an awful lot of movement, a lot of choppiness as the day unfolded. We were up 0.4% on below average volume, and I have an asterisk here because it was options expiration. Usually we see a real pickup in volume there. We are positive in the short, intermediate, and long term. Interest rates are coming back down a little bit. We're still at that 4% level with the 10-year yield. The dollar saw a bit of a pullback, and the VIX is coming down a little bit. So that just suggests a more friendly environment. But we still have some things we want to keep an eye on. And as far as inflation, that seems to be under control right now. And so the market is anticipating the soft landing scenario. But we want to keep an eye on the geopolitical things. There were some major developments this past week between Hezbollah, Hamas, Israel, Iran. U.S. is in there, but so far it's not really having an impact on the market. We'll see if things end up picking up. And we're really watching oil, but oil is now continuing to drop. Okay, so the Dow and the S&P did set new all-time highs yet again. Netflix came out with their earnings, and that was very well received, really up solid. The chart's looking good there, and I'll actually show you that chart later. I go through the charts of the Magnificent Seven or the Great Eight or however many there are there, just because they have such an impact on the index itself. And as I said earlier, American Express came out with their earnings. Even though it was really good, the stock ended up going down. The VIX is now continuing to come down. We're still getting high readings, but now we're below 19. We want to keep an eye on things happening in the Middle East, and oil is dropping below 70 now. And we do have a new addition to the list, the Stochk RSI, which is usually on this list when we're starting to move in one way or the other. So these are our usual charts here. The Stochk RSI, the Williams percent R, the CCI 14 and 20, as well as the stochastics. Now, we treat this a little bit different when sentiment is getting pretty high at 75 or above, which is we're at 75 right now. So now we treat this more as overbought. But we don't actually turn negative until we see confirmation of that. This could also suggest good momentum because just because sentiment is at 75 doesn't mean we're going to stop there. It could go up to 76, 77, 78 as the market sees more optimism going forward. Intermediate term, we still have the Erin indicator giving us a pretty extreme reading. The PMO studies, the rate of change going back 50 periods, the Sean trend meter, the bullish percent index for the S&P. We're getting kind of far away from the 50-period moving average. That's measured by the boom indicator. And the 100-period moving average study, it's been on this list for a few days. And something that is probably more positive, it's a new high, new low study on the S&P that goes over the last 10 periods. That's still giving us a very high reading. And long term, we're still looking good, possibly a little too good with the 150 and 200 period simple moving averages, and then the exponential moving average right on the S&P itself. And one thing that I did change after Wednesday's session is, yeah, the Fed's coming in and cutting rates, but the reports that came out on Thursday were stronger than expected. And so now there's this fear. It didn't seem to happen as much in Friday's session, but it started to creep up on Thursday. Is economic strength threatening rate cuts? If we continue to see stronger than expected economic reports, that's going to throw this 25 basis point cut that the Fed may do. And then after that, still two cuts possible here. It could throw that really into doubt. And because why would they be cutting rates if the economy is getting stronger? They should keep the rates the same, if not even raise them if the economy is getting too strong. The dollar was down, interest rates were down. We're at 4.07% with the 10-year yield where we had been at 4.808%. We're still inverted with the 10 to the 3-month yield curve, but we're uninverted with the 10 to the 2. That hasn't changed. And here's where sentiment's coming in now at 75. I actually showed charts over the weekend in the weekly videos that gives you a historical look at the values of sentiment as they change. We had been at 72. We crept up to 75. We're still looking positive with our trend. Everything is pretty much firing and looking better there. The bias is positive because we had the up day, and the momentum the last 2, 3, 4, 5 days taken together is also positive. So we did get housing starts. They came in at 1.354 million, a little bit more than the 1.35 million they had expected, but down from the 1.361 million we saw last time. Building permits were at 1.428 million, less than the 1.455 million they had anticipated, and also down from the 1.47 million we saw last time as well. And here are some charts just showing a 3-month average. And this is supposed to be a leading indicator because these are things that are just getting ready to get going here. Housing starts and building permits. Those are what you have to do first. Where we look at the blue line here, it is coming up a little bit after it had been declining. And the yellow line is actually coming down just a little bit when we look at this on a 3-month basis. And then looking at housing starts a little bit down from the previous reading. Isabel Net blog charts. This is household equity ownership. And then plotting on here is the S&P 500. You can see they pretty much follow the market. When the S&P is going up, people buy more into the S&P 500. When it's going down, that's when we see folks starting to sell. And just to give it a little bit more context, going back into the 60s, here are some historical events that have happened. And then this is something that I've been pointing out in the weekly videos as well, where we're setting an all-time high with the Dow, but that's not being confirmed by the transports. That's a Dow theory non-confirmation. Now, some people dismiss that and say, well, okay, the market's still holding up fairly well anyway. Some people also say, well, Dow theory's outdated. You should put in the S&P 500 or the equal weight S&P 500, or instead of the transports, we're not a transportation-based society, we're a technology-based society. So put the NASDAQ in there, or the NASDAQ 100, or the equal weight NASDAQ 100 ETF, and compare that. And so I have some different charts that I go over in the weekly video that does just that, shows these different perspectives. But the perma bears, they're just latching onto this, but they would have been latching onto this for 2024 already, as the market's been going up, of course, but they're always declaring that the market's going to tank it. It's just around the corner now. So if you are somebody who thinks Dow theory, if you base your decisions around that, you don't like what you're seeing here, because the industrials are going up as this transports of anything have been going sideways, even slightly down. And then this is kind of a variation of a different chart that we look at. This is the corporate high yield average, and where they're actually going down as far as interest rates are concerned, which is more friendly for the environment. And then Bank of America private clients, they continue to add to T-notes. Now, some other things we were looking at, that they're going a little further out. Now, I remember this by BINBO, BIN Bimbo, which is a play on bimbo. That's how I remember what order these come in. That's just, I do things that way by association. We're seeing money coming out of the shorter term T-bills, but money is continuing to go into the longer term T-notes. And still not really there's a lot of money in there, but not as much in the longer term bonds. So this could be more positive in that folks are, instead of anticipating shorter term rates going up, now they're bumping out to another maturity rate, thinking that, okay, maybe interest rates have topped out and they're going to start to come down, which is kind of what they were doing, but then they started to go back up. And this tends to be more positive for the stock market as well. And then U.S. election sweep probability, it's at 44%. I don't know where they come up with this percent, what they put on here, but comparing October 8th to Thursday, October 17th, that there'll be a Trump and a split Congress, okay? And then a Trump sweep, a Harris and split Congress, and a Harris sweep. And somehow they crunch all their numbers together and they come up with 44%. As we're seeing kind of a shift right now going on within the presidential election, but there's all these other elections that are going on as well. The market would prefer a split Congress, because then that allows Congress to do less and usually when they do more, that means passing rules and regulations. But then there's another side of this argument, where is Congress even doing as much as they used to, because so much is done by executive order these days by the president rather than by Congress. Okay, then cyclicals versus defensives. When this is going up, that means cyclicals are outperforming, and that's usually when the economy's doing well, and they've been doing better lately also. And then systematic strategies. This is where you apply a system to what you're doing, where it has most folks going into stocks right now and actually money going into that currently. And then the consensus expects 72% of companies to grow their earnings per share in the third quarter. As we're starting to get into earnings season now, they're seeing a real pickup of earnings per share growth, and that helps the S&P growth and the price of the S&P to also go up, because it's earnings that drive stocks. I didn't spend any time on Twitter here. Here's the intraday chart where we did have a higher open. We really shot up, but then we immediately saw some selling and it looked like, okay, maybe we're just going to settle sideways here a little bit and could possibly break lower. But we were able to just kind of chop sideways along the daily pivot, or as I said in the note, shop sideways, before finally seeing a little bit of strength coming in. We made it up to R1 and then chopped along R1. Fell back down, but then ended up closing slightly below R1. Intraday pretty much flat as the market closes for the weekend. And the futures were doing okay, but they really started to see some strength, but we saw some selling into that strength after the market opened, only to be able to bounce back later. Intraday, not seeing a real problem here. We would like to see the blue line above the red line, meaning that growth is outperforming value intraday. But the fact that they both, for the most part, have been going up is looking more positive. if we go back here to the beginning of October. And kind of seeing a bit of an improvement over the last couple of days with S&P growth to value with the ratio. It has been bouncing back up. Now, when we really started to go up at the beginning of October and the S&P was seeing some strength, we were seeing this ratio really going up. And then we kind of ran into some sideways to down times slightly. And now we appear to be looking a little bit better right now. On the end of day chart, growth was up 0.52%, where value was up less. Growth was down for the mid caps, where it was up for value with the mid caps, and down quite a bit more with the small caps, where value was up slightly with the small caps. So not really seeing much of an improvement here. In fact, we're still negative overall with the small cap growth to value ratio, mid cap growth to value ratio, and a little bit of an improvement here. Not really breaking down, but not breaking out either with S&P growth to value. And coming a little bit up off of this 250-day moving average with the growth versus value ETF here. We want this to go back up and actually get up out of side of the rainbow if we're more positive. If this keeps coming down and breaks below this 250-day moving average, that would be more negative for the S&P. And still holding up fairly well with the discretionary to staples. Discretionary is showing a little bit of an improvement here, and staples is actually declining a little bit, and that's helping this ratio to actually go up. Large cap growth doing really well, looking solid there. Our trend, we're above the moving average with the dark black line here, and that just shows a strengthening trend, and the green line is on top even though it declines slightly. But we still default to the positive trend here. And in the short term, also, the trend is looking strong right now. And it's still positive, even though the green line came down a little bit. But we're still below average with volume. As far as sentiment, we are dropping a little bit further under 20 with the VIX, both with the line chart and the bar chart. And when okay, I guess I have another chart. Okay, here. Okay, there's obviously a mistake here. We dropped a little bit more with the VIX, with the line chart and the bar chart. And then the VIX of the VIX also starting to drop below the moving averages as the VIX has been coming down. We're actually starting to turn down with the MACD, saying that the momentum of the VIX is now switched to down rather than up. And here's the historical chart, which we just don't seem to really be matching all that closely right now. We're still getting a high reading when we look at the correlation between the VIX and the S&P. It came down, but we're still above this dashed line. Still seeing a higher reading now. We actually went back up with the skew index up into this red area where the market is anticipating some kind of a big move. We went up with this fear gauge and we went down with this other fear gauge. So we're seeing some contradiction. Now, it was options expiration, so some strange things might be going on under the surface. And we ticked up a little bit here with the risk on versus risk off ratio. When this is going up, folks are favoring stocks. Overall, it has been going up, but not really showing a lot of conviction right now. And we're still back to getting a higher reading with the volatility risk premium. We'll see if that ends up switching on Monday after options expiration actually finishes. Okay, we saw a real spike up in the equity put call ratio on Thursday, a real drop off here on Friday. And so what that's done is it's ticking back down with our 5-day, but we're still above this red line that we were coming up out of. That means we're getting extreme with the equity put call ratio based on 5 periods. And usually that can be negative for stocks, but this going down again could be positive for stocks. And we're kind of chopping around, but going slightly lower with the 10-day moving average of the equity put call ratio. Advanced decline line looking really good, setting a new high here based on price and volume. And didn't see a real explosive growth of new highs, but they're still looking pretty solid. Our 5 period is continuing to go flat sideways, but the 10 period is continuing to go up. And we came down a little bit here, but the boom indicator is ticking back up, suggesting that we might be getting a little far away from the moving average, but it's still positive for right now, and we're above an advancing moving average. The advanced decline ratio, both on 19 and 39 periods, is how we look at this, is still looking positive, and we're positive based on price and volume with the advanced decline ratio. This is a little concern here. It could be the drop off in volume that we're seeing, where the chicken money flow, it's positive, but we're starting to go back down, and the red line is going down as well. And this is a smart money indicator. We want to be doing what the smart money is actually doing. So that's why we keep an eye on this. Another smart money indicator is the chicken oscillator, and it's still declining. And the vortex looking positive right now. The green line's going up, the red line's kind of going down here. And we're looking good when we look at the advanced decline line on a cumulative basis for the S&P based on price, setting an all-time high, also setting an all-time high based on volume. And we look at the NYSE advanced decline line. Here's a cumulative measure, setting an all-time high here, looking still solid, even though it ticked down a little bit in Friday's session with the regular NYSE advanced decline line, ticked down a little bit with this other NYSE advanced decline line that we look at that's calculated in a slightly different way. When we look at common stock based on price, ticking down a little bit, the broader market wasn't as strong in Friday's session. So that's why we're not really seeing a lot of breakouts with the NYSE common stock based on price, but we're looking more solid here based on volume. Not really seeing any disconnect between the S&P and the NYSE advanced decline line. They're more or less going in tandem with each other. The advanced decline line study still looking pretty solid, even though we did decline with the small caps. And looking at the ratio between large caps and small caps, actually went up a little bit here. We're not really seeing an awful lot of conviction. Folks are still hoping that the small caps may kick into gear at some point, and they do, but then they stall out and then start to fall back. So the 20-period moving average study, those stocks in the S&P above their 20-day moving average looking good and above 70. So we look at the study here. When we get above the 70 level, that means that there's pretty solid momentum in the short term. We're still looking extreme with the 100-period moving average study. And then those stocks above their 200-day moving average study. Not extreme now, but looking fairly solid. The short-term chart here, we're watching this pivot point. We came up, and that was kind of the high that we set, and we've not been able to actually get above that and close above that right now. So this could be providing overhead resistance. We're also seeing that on the SPY chart, which is the ETF for the S&P 500. And then down below, we see where volume is below average. And showing a little bit of an improvement with the 20 and 50 period moving averages, looking a little extreme since we're above 80 here with the 200-day moving average on the S&P. The Stochk RSI just barely coming into extreme positive territory. The Williams percent R is extreme. CCI 14 is declining, but it's still extreme. The CCI 20 also declining, but continues to be extreme there. The short-term stochastics are extreme. We're extreme in the intermediate term. We're actually rolling over, but still extreme positive with the long short-term stochastics. And the reason I say that is this is a further subdivision of the short-term time frame. The force index is still looking positive. The condition of the 20-period moving average still looking pretty good right now. We're pretty much on these lines, but we're well above the simple and exponential moving averages right now. And we're not necessarily extreme. We're right on the border between the +2 and +3 channel with our standard deviations chart. When we get up into the +3 channel, that's when we're considered to be extreme positive. Intermediate term, we decline, but we're still positive with the balance of power. The 50-period moving average study is looking good. We're above both the red line and the blue line. The go, no go is still looking positive with the dark blue bars. Coming up to the highest high value here, that's positive. But the TTM squeeze continues to trail lower and looking more negative, even though the S&P has been going up. And we're coming down a little bit here with the rate of change going back 50 periods. We got above this red line, and sometimes that's cause for concern. We'll have to see how this plays out. Now, when we topped out here, this was 2022, and this was a bear market. We were really going down. So anytime we would bounce back up, picking out an overbought situation was not that difficult to do. We can get up here and stay overbought for extended time. We'll just keep an eye on this to see if it turns back up or if it continues to fall. We're still positive with the ease of movement. We're ticking down a little bit, but still extreme positive with the Erin indicator. That's positive, though. And we're above zero with the S&P McClellan oscillator. So the summation index based on price and volume continued to go up. We declined a little bit, but we're still above zero with the NYSE McClellan oscillator. So we're starting to turn back up with the summation index based on price and volume. This is a bit of a warning sign. We're declining a bit with price with the Swenlin trading oscillator, but we're still above zero. Also rolling over here based on volume, but we're also still above zero. Momentum is improving. The PMO is above its moving average. We crossed back above the moving average based on price, and we've already been above the moving average based on volume. So just kind of chopping around with the PMOs that are rising. The buy signals are showing an improvement, and we're still seeing a very high reading with the PMOs that are above zero. And these are all the PMOs in the stocks that make up the S&P 500. We've gone from neutral to positive with the Elder's Impulse system. We're positive with the parabolic SAR, trying to turn back up with the short-term slope oscillator here, and we're still looking more positive with the MACD. So our oscillators are showing an improvement, trying to go up with the slope and TSI. Those are the short-term. Looking better here with the MACD, PMO, and PPO, which are more intermediate term. And the reason they're looking a little better sooner is that the slope oscillator was actually declining, where we just saw a little blip down here with some of our intermediate term oscillators. Looking better with our long-term oscillator, the tricks, and turning up but still below its moving average with the KST. Copy curve, trying to cross back above its moving average to turn positive there. The Sean trend meter is extreme positive right now. And we're above 50 with the money flow index. That's positive, declining, but still above 50 with the ultimate oscillator. On balance volume is still just chopping around now, but we're above an advancing moving average. Above all the moving averages that we have plotted here, and all the moving averages are going up. Bullish percent index continues to give a very high reading. It's not really falling down right now, but it's giving us more of a positive flare than a negative flare, but we want to really watch this to see if it does start to decline. We're setting a high now with the NYSE bullish percent index, showing a little bit of improvement and still positive with the NASDAQ 100 bullish percent index. We're not too far away from the 20-period moving average, but we're getting a little far away from the 50-period moving average as measured by the boom indicator. Looking good with the RSI, both in the intermediate and short term. We're above 50 with both. And this is a weekly chart of the S&P, setting an all-time high here, looking pretty constructive going back through most of 2024, where we saw the decline in the spring and then over the summer. But we've been able to really look pretty solid overall. So on a trending basis, we're looking positive with the Heiken Ashi. We're also looking positive with the Kegi chart, looking positive with the Renko chart, as well as the three-line break chart. Long term, we're still well above this red line with the 150 and 200-day moving averages. Positive when we look at all the time frames across all the different indexes with the Keller market model. And bonds are still having some problems in the short and intermediate term based on price. Commodities are negative in the short and long term, but positive in the intermediate term. And the dollar has really been bouncing back up. So it's positive in the short and intermediate term. The only sector that was down was energy. All the other sectors ended up being up for the day with communication leading things higher. But we're watching utilities, we're watching staples, and we're watching real estate as well, because those tend to be more defensive areas. But some of the more cyclical or economically sensitive areas, they had a pretty good day on Friday. Most of the alerts that were triggered were positive. Canada's back to setting a new all-time high. We've got a BPI cross with both the discretionary and communications sector going above 70. That means good, solid strength. The NASDAQ is going up. We did see a BPI cross below 70 in tech, where the Dow set a 4-year high and an all-time high. And not really seeing much of a disconnect between the weighted version and equal weighted version of the S&P. The Dow and we're watching this pivot point too. This could be providing overhead resistance. The Dow's really had a difficult time getting above that, even though it just set an all-time high. The diamonds continue to be positive for the Elder's Impulse system. The NASDAQ has a ways to go to get to an all-time high, but was up 0.63% and looking okay for right now. And the NASDAQ 100 was up 0.2%. Still not really breaking out, but still looking pretty solid nonetheless. We've gone from neutral to positive with the Elder's Impulse system for the Qs, but here's a warning sign. The PPO, the momentum that we use to study or the momentum indicator that we use for the NASDAQ 100, is starting to drop below its moving average, and that could be negative. Small caps coming up to the high end of the range and then falling back. We'll have to see if that continues to happen. Looking at the Russell 2000 small caps coming down after getting extreme positive with the RSI, but the momentum for the Russell 2000 small caps still is positive. We've gone from positive to neutral with the small caps when looking at the Elder's Impulse system. Mid caps kind of chopping sideways right now and still remaining neutral according to the Elder's Impulse system. The Wilshire doing really well, setting an all-time high here with the broad market measure, setting an all-time high with the total U.S. stock ETF. The Staples to Tech ratio kind of chopping around right now, but it has been declining overall. That's positive for tech, but we're seeing that this is in an uptrend. That's actually negative for tech. Financial sector looking pretty solid, not up really strong, but the chart is still looking really good. The FANG index was up 1.33%, not to an all-time high yet, but showing some improvement there. And we continue to bounce around between the short-term and the longer-term trend lines here. Apple was up 1.23%, looking pretty solid. Amazon was up 0.78%. Meta was down slightly, but still looking pretty good. Microsoft, we're watching to see if a death cross is going to be generated. It has not happened, at least yet. And Google also hanging out just a little bit above its 50-day moving average. NVIDIA setting another new all-time high here. It's looking pretty good that way. Tesla is still hanging out below its 50-day moving average. And then Netflix really spiked to the upside, setting a new all-time high as their earnings report was well received. And still seeing more of a deterioration in the short term between U.S. stocks and world stocks. This correlation is going down, and we're starting to go down more in the longer term as well. Oil is dropping below 70, so the market's really not reacting to what's happening in the Middle East. The dollar, now, according to the way I measure trends here, we're still in a downtrend. We have the moving average crossover that happened here. And we came up and we right to the 200-day moving average. We're going to see, is that going to provide overhead resistance? Are we going to see the dollar bounce down from that? Or is it going to be able to break above its 200-day moving average? And we came down with the 10-year yield. We were up with the 10-year based on price, but we're still over that 4% level. Not really seeing much of a change here with the Qs to S&P growth to value ratio. Discretionary to S&P dropping below its moving average, and the moving average is going down. And pretty much on top of the moving average when we compare large cap growth with large cap value. So the large caps on the moving average coming down to the moving average with the mid caps and below the moving average with the small caps. So not really seeing much improvement that way. And for the most part, the S&P to utilities ratio has been going down. We want this to go up to be more positive. And this is, it ticked back up, but it's starting to go down. This is more positive for the S&P when this particular ratio goes down. Just an update of the Hindenburg-Ullman, no more confirmation signals, but we do have these two spikes here that were generated on October 3rd. Oh, we had until October 3rd. It was confirmed on September 12th after the first signal was generated on September 5th. So that's still on the books. So what's our outlook for Monday? Friday was options expiration, so that might explain something that happened in the market anyway, except we didn't really see an increase in volume. We're still positive now. I haven't changed this. We have this confirmed Hindenburg-Ullman, and we're still getting some warning signs from the VIX, but it doesn't seem to have much of an impact. Now the VIX is starting to come down, at least it's dropping under 19. And I didn't update this. I'll have to go to the next chart here. We want to keep an eye on all the geopolitical things just to see if they have an impact. Here's the economic calendar for the upcoming week. We're going to get leading indicators, or LEI, on Monday. There's nothing coming out on Tuesday. And then we get the usual things here, existing home sales, not a major report, but jobless claims have become kind of important. And then on Friday, we're going to get durable goods and consumer sentiment. And here's a look at the different things that, according to this calendar, they deem as more important, with most things happening on Wednesday, Thursday, and then on Friday. Seasonality, neutral to positive across the board for October 21st. But this is the week after options expiration where we tend to be down more than up. And we do see some negative seasonality coming in after we just got through a period of really short-term positive seasonality. But you can see the green dashed line has a tendency to decline. That's the S&P during an election year. Monday is, though, the most positive day compared to what happened in 2023. It's the third most positive day based on what has happened thus far in 2024. And still watching the seasonality chart, but we really haven't been paying attention to that since the market hasn't been following it all that much. This is something that we have been keeping an eye on. As companies report their earnings, they go into blackout periods where they can't come in and buy their own stock. We're seeing fairly high readings for a Monday session. So there's still a lot of companies that can't come in and buy yet. So what is looking more negative right now? This Hindenburg-Ullman, we're keeping an eye on the defensive sectors to see if they bring some negativity into the S&P, but we've been watching this for quite a while, and it hasn't had much of an impact. The equity put call ratios, they're actually switching back over and looking more positive. They're turning back down now. And we're keeping an eye on the growth to value ratios, which are not really giving us a lot of confidence. The S&P is looking okay, but it's not really breaking out. We are more encouraged by the discretionary to staples ratio that we're seeing. And we're getting all these VIX signals now, but we've been doing this for over a week now. And it really hasn't led to anything, at least yet. Now, if the VIX keeps coming down, that may make some of these signals go away. And we're concerned that the NASDAQ 100 momentum is starting to turn negative. So the positive side, accumulation distribution looking pretty good. You might make a case that we're getting a little far away from the moving average. The Chaikin money flow is positive but declining, as is the Chaikin oscillator. We're looking positive with the S&P and NYSE McClellan oscillators and summation indexes. The advanced decline lines are holding up fairly well. The oscillators are switching back and looking more positive. We're still extreme at the bullish percent index for the S&P, getting really high with the NYSE, showing some improvement with the NASDAQ 100 bullish percent index. The parabolic SAR is positive, as is the Vortex. The Swenlin trading oscillator, but we saw price starting to turn down and volume beginning to roll over a bit. It's positive, but we want to keep an eye on that one. The money flow, the ease of movement, and the ultimate oscillator continue to be positive, and the financial sector is positive. So a lot of good things that the market's latching onto right now. So our conclusion, we are positive, but we have this Hindenburg-Ullman in the background, which may end up being a nothing burger, but it could turn into something at some point, especially if we get more confirmations. And we're keeping an eye on these VIX signals that we've been getting. In the short term, we're positive, but now we're looking a little extreme. And now that we have sentiment going above 75, that's causing a little bit more concern. We're still positive in the intermediate term, but we also have kind of a long list here, but we would just say slightly overbought in the intermediate term. We're still positive in the long term. So thank you. I hope you have a really good weekend, and I will talk to you in the next video.